One of the goals of this course is to take fairly complicated information about different countries and translate that into some sort of quantitative rule. Now, you've seen one company's analysis of admissible countries. And that analysis is useful in that the company goes through and separates out many different risk factor categories. For example, political risk. And within the political risk category, they might have 5 different sub-factors. The way that a country is scored is that each of these sub-factors gets a rating between 1 and 3. And then those are summed up and contribute to the weight of a particular factor such as political risk. We add everything up and we get a number for a country. And the particular company that we looked at, they made some cutoffs, for example, and this is only an example, that if your rating was above 80, then this would be a company within a country that we would invest in. If the rating for the country was above 60, then we would scrutinize it very carefully, but it would be admissible. And below 60, we would not entertain an investment within that country for any company. Now, this sort of analysis, as I said, while useful in providing a structure to look at the particular risk factors that are important for investing in a country, has got some problems. For example, the weights that are used for various different risk categories, like political risk, are the same for every country. And I can certainly imagine a scenario where political risk should get a bigger weight for one particular country than another country. The other more fundamental problem is, how do we translate this information into a quantitative rule? To draw the lines arbitrarily at certain levels and say, well, this country is admissible, but this country isn't, seems rather ad hoc. So what we would like to develop in this course is a system whereby we can retain the positive features of this type of analysis in terms of going through all of the different risk factors, allowing for weights for these factors that differ across countries and differ across time. And most importantly, what we need to do is to take this information and to translate it into some type of hurdle rate. Obviously, a country that has a low rating is riskier. And that risk should manifest itself in the expected return. So we will develop a model that takes ratings, translates those ratings into expected hurdle rates. It still might be the case that for a number of these countries, they will not be admissible targets for us. But we will have a consistent framework that allows us to determine what the expected return should be in that country given its risk.